take it away.
All right. Thank you so much. Let me go here. Okay. Well, thank you so much for Evgeny for putting together this great conference and having the paper on the program. The paper is joint work with my former PhD student Frank, who is now at Fidelity Investments. And what we're after is really trying to understand what drives co-movement in cryptocurrency markets. And this is an important issue because as of last week, there are more than 10,000 cryptocurrencies today, traded on over 500 exchanges around the world. This number keeps creeping up and up and up. Aggregate market cap is around $2.5 trillion. And on average, even when the market is down or up, these markets trade around $150 billion a day. So there's a big cross section, and for investors engaging in investments in this market, it's really important to understand what drives covariation, say when building portfolios or doing risk management. Now, the literature has posited two channels driving the core movement in the space. One being kind of a standard from a French common risk factor story, that there's kind of risk factors that price the cross section of these cryptocurrencies. And so far, we have kind of four to five factors in the space: a standard market factor, a size factor, a momentum factor. Will's new paper introduces kind of like a network factor, and there's other kind of characteristic-based factors as well in the space. So we understand that there's some common risk factors. Then in addition to that, Amin Shams says a neat new paper that argues that because there's something very unique in the space, and that the same cryptocurrencies can be traded on different exchanges, and that these exchanges often have geographic restrictions as to what investors can trade on those exchanges, that shocks to sorry, let me put this down. So shocks that are restricted to a certain geography may spread to different cryptos just because they're co-listed on certain in different exchanges. Now, what we argue in this paper is, or what we introduce, is a third channel that drives co-movement in this market, and it's partially a behavioral story, and it relates to mispricing across peer assets because of an overreaction to news reporting. And I'm going to present three different sets of results. Let me just keep track of time. The first result is going to be a contemporaneous co-movement in this market. So what I'm going to show you is that when certain cryptocurrencies experience abnormally negative shocks, that peers of those cryptocurrencies experience abnormally positive performance. And the way I'm going to illustrate this is through this figure here in the bottom, where I consider three subsets of cryptos in weeks surrounding an event week. So I'm going to define an event week as a week in which some cryptocurrencies experience excessively negative abnormal returns in excess of risk factors. Those are going to be these shock cryptos that are going to be in the middle plot in this figure. And what you observe is that these are big shocks that hit these shock cryptos. They experience abnormal returns of around -11 to -15% in those weeks. Now, what I'm going to argue is that certain peers of these shock cryptos are going to experience the opposite performance. So during these event weeks, these peers are going to experience abnormally positive abnormal returns. And this is going to be economically sizable, of the magnitude of around 5%. Now, what I'm going to show you is that this co-movement is concentrated among a certain set of peers. They're going to be peers that we identify from online news. So the news co-mentions these peers, and investors react to that information. And it's going to be peers that are co-listed in the same exchanges, in that investors can transfer their funds from these shocked assets to these peer assets. So overall, what I'm going to show you evidence is that this is kind of this is mispricing that arises because investors overreact to information about these shocks that is pricing irrelevant. Ultimately, the second set of results is going to relate this contemporaneous mispricing to predictability. And I'm going to show you that it takes investors time to realize that they've overreacted to this information. And as they process this information, the prices of these peer assets that are now overpriced are going to come back down. So we're going to build trading strategies that exploit this predictable reversal, and those trading strategies are going to have high alphas and high Sharpe ratios in excess of fees without any factor exposure. Now, what's really important here is that what we're showing is that there is a reaction to information that is reported in the news. So in a way, when we tend to think about how assets should co-move in this setup, we either expect them to not co-move or co-move in the same direction as posited by some sort of contagion mechanism. But what we find is that the reporting in the news can change the way these peer assets co-move. And that's really something that's new and novel, not just in crypto, but potentially for other markets as well. And then the final set of results is going to really relate to how we identify peers in these cryptocurrency markets. What we're going to do is we're going to develop a natural language processing methodology that reads online news and tries to understand when two cryptos that are co-mentioned in these online news are in a peer relationship. This is going to extend a previous methodology that Frank and I had another paper. And even though this is a very black boxy kind of methodology, in the paper, not in this presentation, we have a lot of evidence that shows that when we say to cryptocurrencies are peers, they are more likely to have similar sizes, similar factor betas, similar ages. They tend to operate in the same industries. And all of these just tell us that they share similar characteristics. So even though our methodology is black boxy, the data suggests that this black box actually is capturing some relationships that we would label as peers. And this really extends existing methodologies because it's hard to I mean, first of all, in this market, there's no clear definition of what a peer is. And even in other markets, it's not as easy to identify peer relationships in financial markets. Hoberg and Phillips have a neat paper that looks at peer firms and argues that we can use NLP to identify how similar the corporate filings are of two different firms, and based on that, assess peer relationships. And here we introduce a different methodology that exploits different text data to still be able to assess peer relationships. So I'm going to jump straight into the approach. Anybody that has worked on crypto knows that cryptocurrency is very messy. We're going to collect data from 3 different sources. CryptoCompare, which is one of the most popular data sites, we're going to use primarily to obtain news data. So one of the things that CryptoCompare does very neatly is that they collect online news articles published in an array of different sites like Bitcoin.com, Yahoo Finance, and many other ones, and then provide this data freely available. So it's a really neat source of news data. We're also going to collect characteristics for the individual cryptos, like what industries their product operate in and when they started trading and so on. One thing that CryptoCompare is really poor about is pricing data. So CryptoCompare is flooded with pricing errors. It's constantly, it's really hard to deal with that data. So what we're going to do instead is we're going to move to CoinGecko because CoinGecko is an open source data source that where users can kind of correct or flag errors in the data. So it tends to be very accurate in terms of prices. And obtain trading volumes and prices from CoinGecko. We also collect some social media data, but I'm not really going to present any evidence on that. And then finally, we're going to go to CoinAPI, which provides exchange data. So from CoinAPI, we're going to be able to say which cryptocurrencies traded on which exchanges at which point of time. And that's going to allow us to control for the correlated demand channel of AMEX shops. Now we're going to consider the 100 largest cryptocurrencies by market cap that were alive at some point during our sample. And the time period is going to be October 1st, 2017 through November 30th, 2020. Now, this may seem like a short time period, but because of the wide cross-section, we actually obtain a lot of data. We have around 90,000 crypto week observations. We're going to construct abnormal returns in this market in excess of a market factor, size factor, and a momentum factor. The market factor is value weighted, but the size and momentum factors are equally weighted. So these abnormal returns are not just going to capture size effects. And based on these kind of regressions, we're also going to compute idiosyncratic volatilities, which are going to be the volatilities of the residuals that we obtain from these regressions. We next proceed to evaluate which cryptocurrencies are peers to which cryptocurrencies. And we do that using a methodology, a natural language methodology, NLP methodology, that extends the previous methodology that we had. Our original methodology, all it did is kind of read through text data and say where two financial assets are mentioned in the text data. Now, what we're going to do is we're going to extend this methodology to identify cryptos and then label the relationship as competitive. The way we're going to do this is we're going to take all the sentences in which two or more cryptos are mentioned through a deep learning methodology that is going to label those sentences as describing a competitive relationship versus a non-competitive relationship. We trained the model using hand-labeled sentences that we identify as describing competitive relationships. So for us, peers and competitive relationships are synonymous, and that may not necessarily be the case for everybody. But to the extent that this is the case, then these are the results we're going to find. And then we're going to go through all of our data and identify peer relationships based on this methodology. Over time, what we're going to obtain is a network of peer relationships in cryptocurrency markets. We're not going to use this data that much, but what we're going to do is anytime we observe one of these very large abnormal return shocks, we are going to see in those event weeks which cryptocurrencies are identified as peers to these shock cryptos and which ones are not. Now, when doing this analysis, there is a couple of challenges. And the main one for us is that, well, the first thing is that we're going to identify shocks as shocks to these abnormal returns. So we're going to say a cryptocurrency is shocked whenever the realization of the abnormal return lies in the bottom decile of the cross-sectional and time series distribution of those abnormal return shocks. But the main issue is that there's high dispersion in these abnormal return shocks. So we have idiosyncratic volatilities reaching from 1% to over 40% in the cross-section. So we have to kind of do some sort of standardization to be able to compare one-to-one. And the way we're going to do this is we're going to do standardization on a rolling basis using the prior 60-day mean and variances. So at any point of time, you can look back and kind of compute those mean and variances and standardize. So there's no kind of forward-looking issue bias here. So then we're going to look at the standardized abnormal returns. If one of them lies in the bottom decile of their distribution, we're going to say that's a shock. And then we're going to identify peers and non-peers and run diff and diff regressions of the abnormal returns in the weeks surrounding those events. What we find is just, the diff and diff coefficient is very significant. And in economic terms, what this means is that when shock cryptocurrencies experience excess abnormal returns of around minus 15%, the peers that we identify in our data experience excess abnormal returns of around plus 5% in excess of characteristics and risk factors. Now, at this point, this is purely correlations. This is just like, well, we run these different diffs and this is what we get. So what we really want to do is then try to understand the economics. Why do we observe this? And what I'm going to show you is that the reason we observe this is that investors overreact to this information that is reported in the news. Now, the first thing I'm going to do is I'm going to evaluate how informative are these shocks. And that's going to allow me to assess whether this is mispricing. What I'm going to do is I'm going to define a shock as being informative or informational in nature when that shock is accompanied by abnormally high information production for the shock cryptos. So we're going to label a shock as informative if the number of times the shock crypto appears in the news, if the trading volume for those shock cryptos or the idiosyncratic volatilities for those shock cryptos are very, very large. And what we're going to find is that most of the co-movement or all of the co-movement we identify is actually concentrated in events that are non-informational in nature. So these are by construction idiosyncratic shocks, but they're also idiosyncratic shocks that are they don't reveal a lot of information for prices. Now, the next thing I'm going to show you is that even though these are non-informational shocks, investors still react to this information. What we do is we look at the co-movement of the different subset of cryptos, and we find that the co-movement is concentrated among peers that we identify from our online news data and peers that are co-listed in common exchanges. Indeed, when we look at peers that are not identified from the online news, but are operating the same industry, we find co-movement in the same direction that is consistent with kind of a contagion channel that Amin Shams would have posited. But once these peers appear in the news, then the co-movement completely flips direction. So we find in the paper as well that these peers, online news peers, experience abnormal information production, and they also experience abnormal turnover during these event weeks. So it really seems that investors see this in the news, they react to this information by moving funds from these shock cryptos to these peer cryptos, and that's when we see them mispricing. In the final set of results, what I'm going to do is I'm going to show you, well, what does this then imply for predictability? Because if this is indeed mispricing, then the prices of these peer assets should revert back after the event weeks. And so we look into that and we find that indeed in the weeks after an event, the prices of these peer assets that appear in the news and are co-listed with these shock cryptos revert back down at a rate faster than any other crypto in this market. So what we want to do is we want to exploit that these prices revert down predictably. The way we do this is we build trading strategies where we short these assets that are going to come back down. And to keep the strategy market neutral, we then go long on Bitcoin, even though we can obtain similar results without this long leg. We're going to keep these positions, these long short positions, open for several weeks. And then we're going to assess the performance of these trading strategies as we increase the holding period of these positions. Consistent with this predictable reversal, what we find is that if you keep these positions open for 6 weeks or longer, you're going to be able to generate significant alphas in high Sharpe ratios without any market factor exposure. And if you hold these positions open for 12 weeks or more, you're going to, for 12 weeks, you're going to kind of maximize the Sharpe ratio that you can obtain at 2.1. Now, this performance metrics are all after fees, where we use the fee schedule that Kraken would use to short sell in this market. Now, again, okay, this is predictability, great, we can build trading strategies, but we want to read down again on the economics, like why do we observe this predictability? And we argue that the reason why we observe this persistent predictability is because it takes investors time to digest the information, to digest that they've overreacted to information. The way we test that is by looking at trading strategies restricted to different subset of cryptos that have naturally different speeds of information processing. We know from the equities market that larger assets have faster speed of information processing because they have more institutional investor tracking. Therefore, we should expect that if we only short sell these large cryptos, that the speed that investors should process information for those cryptos faster, and therefore the reversal should take place at a faster rate for those cryptos. Similarly, Kraken short selling in crypto is not a given. You cannot short sell all cryptos, but Kraken does offer short selling on a subset of cryptos. And we posit that those cryptos that have margin trading and short selling on margin available should probably be tracked again by institutional investors, and therefore they should have higher speeds of information processing. So we look at what happens to the performance metrics in these two subsets of strategies where we have naturally higher speeds of information processing, and we find indeed that the reversal occurs faster among these cryptos that process information faster. So again, this points to the fact that investors are reacting to the fact that they've overreacted to information and try to undo basically the mispricing. Now I'm running out of time. In the paper, we have a bunch of robustness analysis. Some people may not like the fact that we use these standardized returns and we use kind of different diff regressions. We find exactly the same returns when we use raw returns and we just do kind of peer returns regressed on shocked returns, and we find negative cross correlation here. The results survive after removing Bitcoin and Ethereum, so this is not like a big asset kind of phenomena. And they also survive when we kind of ignore the smallest coins. So this is not like a flight to quality phenomena. Some people may think that this is an issue that some of these shocks are endogenous. We find both similar results for exogenous and endogenous shock, though to a weaker degree to endogenous shock, which again points to the fact that investors overreact to information and they don't really understand what this information really means. We carry out several placebo tests, and they confirm that, yeah, if we were to just randomly link peers or linked peers, if they have similar performance or similar sizes, we wouldn't observe this kind of behavior. And then finally, we also find directionally equivalent, albeit economically smaller results when we look at positive shocks rather than negative shocks, which is consistent with these behavioral bias that investors tend to overreact stronger to negative shocks than to positive shocks. So overall, what we have is we document co-movement among peer assets that are co-listed in the news in response to idiosyncratic shocks, and that this is primarily driven by an overreaction to pricing relevant information that yields predictability because it takes investors time to undo this mispricing, and trading strategies that exploit that have high Sharpe ratios. And ultimately, all of this is based on an NLP methodology that identifies peers from online news, and that methodology is available on our websites. All right, thank you.
Thank you, Gustavo. So the